The idea is simple and steady. Buy strong firms. Hold them for a long time. Do not react to every market move. Let time do the heavy work. 10 years gives compounding room. Small yearly gains grow into much more. A calm, slow plan beats fast trading. This approach fits patient money. A long time matters more than most people think. Compounding rewards steady growth and reinvested earnings. A firm growing a bit each year becomes much larger in a decade. Time smooths short shocks and odd quarters. It also shows which firms keep improving. Long views cut short-term noise. They let strategy win over emotion. That is why long time matters. This list focuses on themes that can grow. AI cloud chips ads, enterprise tools. These areas need big capital and long upgrades. Firms that lead these themes can earn for many years. The companies here fit those long trends. They are not promises. They are informed choices. Read more and think calmly before you act. This essay keeps language simple and tone calm. Sentences are short and clear. Each company gets a brief, direct note. You will get one simple reason to hold each stock long-term. You will also see a short risk note later on. Do your own study before you invest. Only use money you can leave for 10 years. Do that. A calm, slow plan beats fast trading. 10 years gives compounding room. My list would include NVDA, MSFT, AMZN, Meta, AVGO, Google, PLTR, Dell, TSM, and AMD. These companies center around AI, cloud computing, semiconductors, digital advertising, and enterprise software. There will be corrections along the way, and I would only invest if I don't need the money for 10 years. As always, do your own research and invest according to your risk tolerance. Let time do the heavy work. NVIDIA makes chips for AI and graphics. Its GPUs run many AI models and power data centers. The firm also builds software to support AI work. NVIDIA sells to cloud firms and to enterprises worldwide. It leads in AI training hardware. The demand for AI compute is rising fast. NVIDIA earns high margins on its products. Its ecosystem makes switching costly for buyers. NVIDIA can grow as AI expands. More models mean more chips and more servers. Data centers plan for heavier workloads. AI inferencing will need more efficient chips too. NVIDIA works on both training and inference. It also sells systems as a service. Partners build products around its stack. One simple reason to hold NVIDIA long-term is leadership. It leads in the most in-demand AI hardware today. Competitors exist, but NVIDIA has a large lead. Many firms design around its tools and drivers. This advantage can last years if it keeps investing. Leadership attracts more customers and partners. That makes future growth more likely. It also raises the bar for newcomers. Keep in mind there are risks to NVIDIA. New architectures could appear and lower demand. Supply can be disrupted by geopolitics. High current valuations can correct suddenly. Customers might diversify to other chips. Regulatory rules could affect exports. Competition from big rivals is real. Microsoft sells cloud services, software, AI tools. Azure is its cloud arm. Office Teams Windows brings steady cash. It also builds AI services and tools for businesses. Microsoft serves millions of enterprises globally. It ties many services together for customers. That gives steady revenue streams. It manages large enterprise relationships. Microsoft can grow with cloud and AI demand. Businesses shift more workloads to Azure, SaaS. Companies pay for security, collaboration, AI features. Microsoft often bundles value across its products. This cross-sell keeps customers inside its ecosystem. It invests in AI at scale, buys firms to fill gaps. Those moves can sustain long-term growth and profits. One simple reason to hold Microsoft long-term is diversity. It does many things well and earns across cycles. When one area slows, others often help. Its enterprise reach makes renewals frequent. Large clients rarely switch quickly. That steadiness supports long-term returns. The firm also returns cash to shareholders. This mix suits a buy-and-hold plan. Still, Microsoft faces risks you should know. Antitrust, regulation can change its business. Cloud competitors can pressure growth. Enterprise budgets can slow in recessions. Deals and acquisitions can fail or cost more. Currency shifts may hurt revenue. Tech trends might alter demand over time. Watch these risks and keep a long view. Amazon runs the biggest cloud platform and a big retail business. AWS leads in cloud services infrastructure. The retail arm sells goods and handles logistics worldwide. Amazon also earns from ads and subscriptions. Its scale allows low prices and fast delivery. That scale supports wide moats in retail and cloud. The company reinvests profits into growth initiatives. Amazon can grow as cloud and e-commerce expand. AWS often wins large enterprise contracts. Retail and ads bring steady cash flow. Amazon invests in logistics, AI, and new services. Those investments can open new revenue streams. Its scale allows experiments at low marginal cost. One simple reason to hold Amazon long-term is its combined model. Cloud profits and retail scale work together. AWS brings high margins and repeat business. Retail brings volume and user data for ads. This mix can support growth through cycles. It also gives the firm options to pivot. The combined strength matters over time. Risks to Amazon include thin retail margins and heavy spending. Competition in retail and cloud is fierce. Regulatory or tax changes can alter profitability. Logistics costs can rise. Investments sometimes take longer to pay off. Market shifts can change shopping habits. Expect periods of weak returns and volatile stock moves. Meta runs large social networks and an ad business, Facebook, Instagram. Other apps reach billions. Ads fund most of its revenue. Meta builds AI to improve ads. Meta builds AI to improve content. It also invests in virtual reality new platforms. User attention, data matter to its model. That gives it an ad targeting edge. Meta can grow if ads remain digital and precise. Advertisers pay more for better targeting. AI helps match ads to users and measure results. Meta's scale makes it attractive to marketers. Strong revenue from ads funds new investments. These funds can support long-term product shifts. That keeps future options open. One simple reason to hold Meta long-term is ad reach. Few firms match its size and user engagement. That reach drives ad sales and data depth. Better AI can boost ad relevance and price. The firm also diversifies into new products slowly. That steady cash helps it adapt over years. Size gives a durable platform advantage. Meta faces specific risks that matter. Regulation can limit data use or ad targeting. Privacy changes can reduce ad value. Ad budgets can swing in slow economies. New platforms may lure users away. Large investments in new tech may not pay off. Public perception can affect engagement. These risks can hit the stock hard in short bursts. Broadcom makes chips and also sells enterprise software and infrastructure. Broadcom makes chips. Broadcom sells enterprise software. Broadcom sells infrastructure. It serves networking markets. It serves storage markets. It serves telecom markets. The firm often grows through acquisitions. It earns high margins on critical components. Broadcom partners with big cloud and equipment firms. Its products sit deep in tech stacks. That creates steady demand and recurring revenue. Broadcom can grow by adding firms. Broadcom can grow by adding products. Acquisitions expand its market. Acquisitions expand its technology. Its scale helps keep margins high. Networking and data center spend can rise with AI demands. Broadcom also sells firmware and software with long contracts. Those parts add stability to hardware sales. This mix fits a long-term holder. One simple reason to hold Broadcom long-term is margin strength. It earns strong profits across cycles. Its acquisition strategy has enlarged revenue and scope. Customers often value its integrated offerings. That can lead to steady cash flows. Steady cash supports dividends. Steady cash supports buybacks. These help long-term compounding. But Broadcom has risks to watch closely. Heavy reliance on acquisitions can fail. Regulatory approval can block deals. Customer concentration can pose threats. Tech cycles can lower demand unexpectedly. Integration of new firms can be hard. Competition in chips is strong. Competition in software is strong. Keep these risks in mind when you hold. Alphabet runs search, ads, cloud, and AI research. So, Google Search drives much ad revenue. YouTube drives much ad revenue. Google Cloud is growing and earning more market share. The firm invests heavily in AI across its products. That investment improves search, ads, cloud services. Alphabet also builds new bets like Waymo and other projects. Its cash position is very strong. Alphabet can grow as ad tech and AI evolve. Better AI can make search more valuable and ads more valuable. Cloud demand supports enterprise revenue growth. YouTube adds video ad strength and subscriptions. Alphabet Scale supports massive R&D investment. That allows it to stay at the frontier in many areas. Long-term bets can become major new businesses. One simple reason to hold Alphabet long-term is search dominance. Few firms match Google's search reach or ad depth. That dominance feeds consistent ad sales and data insights. Cloud and AI add new growth legs. The firm's balance sheet supports bold moves. That combination suits patient investors well. Alphabet also faces risks you should note. Regulation and antitrust action can change its core business. Ad markets can change with consumer trends. Privacy rules can reduce ad targeting. New competitors can erode market share in cloud. Investment bets are costly and may fail. Expect periodic setbacks and volatility. Palantir builds data and analytics software for companies and governments. Its platforms help organize, model, and act on large data. Many clients use Palantir for security, operations. The firm focuses on long contracts, deep integrations. Palantir often customizes solutions for big users. That leads to recurring revenue, long client ties. Palantir can grow as data use expands in many sectors. Governments, firms need tools to analyze more data. Palantir's software can be mission-critical for clients. Long-term contracts build predictable revenue streams. The firm also expands into commercial markets. Its experience with complex customers is a selling point. One simple reason to hold Palantir long-term is niche strength. It has a strong position in data-heavy, mission-critical use cases. Deep client ties can last for many years. That makes revenue more stable than it first appears. As data needs grow, its tools stay relevant. Long sales cycles can turn into long contracts. That supports slow and steady growth. Still, Palantir has clear risks you must weigh. Sales cycles are long and unpredictable. Heavy reliance on government contracts can be risky. New competitors could win contracts. Its stock price can swing on quarterly news. Execution risk is real with large bespoke projects. Watch client diversity, contract renewals closely. Dell sells servers, storage, IT services to businesses. It provides hardware for data centers, edge computing. Dell also supports customers with services and financing. Many firms buy Dell for integrated enterprise solutions. It competes on price, support, supply chain scale. That gives it access to steady corporate budgets. Dell can grow as enterprises renew and expand infrastructure. AI, cloud, hybrid work create demand for servers and storage. Dell's services help customers upgrade and financing offers flexible terms. Its broad portfolio covers many enterprise needs. Strong OEM partnerships boost sales channels. This position helps Dell stay relevant long-term. One simple reason to hold Dell long-term is hardware presence. Many enterprises must buy servers and storage regularly. Dell is a familiar, trusted supplier for many IT teams. That repeat business supports steady revenue. Its service contracts add recurring revenue. Over a decade, hardware buyers will need refresh cycles. Dell can benefit from those cycles. But Dell faces risks to remember. Hardware margins can be thin and pressured. Competition from cloud providers can reduce on-prem spending. Supply chain and component costs can rise. Technology shifts can change server demand. Dell needs to adapt to software-driven models. Watch margin trends and product mix changes closely. TSMC makes chips for many top firms. AMD designs processors and GPUs. TSMC fabricates advanced semiconductors at scale. AMD designs CPUs and GPUs used in servers, PCs, consoles. The two firms are partners in many markets. TSMC's factories enable many chip leaders. AMD brings competitive products to market. TSMC can grow as chip demand rises for AI, phones, autos. It invests heavily to stay at the leading edge. Advanced nodes are costly but needed by top chip designers. That gives TSMC pricing and volume power. AMD can grow by taking share in servers, gaming. Better designs have helped AMD win market share recently. One simple reason to hold TSMC and AMD long-term is supply chain centrality. TSMC is the main advanced fab for many firms. AMD competes well across CPUs, GPUs. Together, they sit at critical points in the chip ecosystem. If compute demand grows, both can benefit. Long-term demand for advanced chips is likely to rise. Still, both face clear risks you must note. Geopolitics can affect TSMC's operations. Building new fabs is costly and risky. AMD faces intense rivalry from Intel and Nvidia. Supply shortages can slow growth. Technology changes can shift advantage quickly. Watch global tensions and capex plans closely. Risk is real for all stocks. Markets fall, rise in cycles. Prices can drop sharply in corrections. Firms can lose share, face regulation. Supply chain problems can hit chip makers. Ad markets can slow in downturns. Even strong leaders can wobble for a time. A simple plan helps manage that risk. Only use money you can leave for 10 years. Buy slowly over time. Rebalance if your goals change. Keep an emergency fund outside the market. Avoid debt to buy stocks. Check news but do not react daily. Keep a steady mindset. Short reasons each company might face trouble are worth repeating. Nvidia could meet new rivals. Nvidia could face slower AI demand. Microsoft could face regulation. Microsoft could see cloud slowdowns. Amazon could see thin retail profits. Amazon could face stiff rivals. Meta could lose ad strength. Meta could face privacy rules. Broadcom could struggle with failed deals. Alphabet could face fines. Alphabet could see ad shifts. Palantir could have long sales cycles. Dell could see margin pressure. TSMC could face geopolitical risk. AMD could lose share to big rivals.